Just really quick, in its very simplest terms, basis is the dollar value of the S-Corp members' investment in their S corporation. So it starts off with, whatever personal money you, for example, that you deposit into that. This was not a thing that I caught. Like, this was not a thing that I necessarily fully understood how to do. So I would imagine if I were to go back to look at some of my S-Corp returns from 11 years ago, this might not be what actually happened on those tax returns. Just remember, just because you see something on the book P&L does not mean it belongs on the income or expense section of the 1120S. There's a lot of book to tax differences that you have to think about with pass-through entities. So the first thing we're going to talk about is distributions in excess of basis for an S corporation. Without, we could do a whole class on just basis and how to calculate it, but for those of you who already know this, you can tune me out for 10 seconds. And for those of you who aren't exactly familiar, pay attention. Just really quick, in its very simplest terms, basis is the dollar value of the S-Corp members' investment in their S corporation. So it starts off with, whatever personal money you, for example, that you deposit into the S-Corp bank account to open the bank account when you start the business, right? That adds to basis. Basis is a constantly moving target. So if you do tax planning for S corporation clients, you're having to regularly review that. It goes up for net income. It goes up for capital contributions. It goes down for net losses. It goes down for distributions. It goes down for non-deductible expenses. So as you can see throughout the year, if you're trying to advise your clients how much they can take in distributions, you're having to constantly recalculate their basis so that you can give them good advice. Now, I don't know about you, but I have S corporation clients who either don't contact me before they take distributions or don't understand that there are negative repercussions because somebody's mother's brother's uncle told them they needed to be an S corporation, which was probably hogwash. They really can't afford to be an S corp, but here we are. So what happens when they take distributions in excess of their basis is what should happen, what often gets missed, but what should happen is those excess distributions get reported as capital gains on their personal tax return. So when they take distributions in excess of basis, it will have a tax impact on their personal tax returns. So let's take a look at what this looks like. Now, obviously, this is a very simplified S corporation tax return because I didn't need to build it all the way out. In this example, this S corp grossed $70,000. They paid their S corp shareholder $40,000, and they had $20,000 of regular operating expenses for $10,000 of net income. Now, in its simplest terms, they now have $10,000 more of basis in their company, right? Net income basis goes up for net income. So here's their K1. It shows their $10,000 of business net income. We can also see on this K1 that they took $30,000 of distributions. Now, I should already be thinking to myself, like, there might be a problem here. They only had $10,000 of profit, but they distributed $30,000. That math doesn't math. So now I need to know what was their beginning basis heading into 2023. In this example, and this is just the distribution sheet to show the $30,000. So in this example, heading into 2023, they had $1,000 of basis. So that's what carried forward from the previous year. We add the $10,000 of net income for 2023. So now their basis is $11,000. They distributed $30,000. So 11,000 minus 30,000 is a negative $19,000. Now, when you're talking about basis is never negative. Basis can go to zero and then it stops. So if you're using the term negative basis, stop. Capital accounts can be negative, but basis is not negative. Sorry, I'm gonna close my door because the dog only barks when I'm in meetings. So in this example, as you can see on this basis worksheet, and the worksheet that you're software puts out should look something very similar to this. But the stock basis at the end of the year, line 11, is blank because it's 0. 11,000 minus 30,000 is a negative number. Basis is never negative, so it's just 0. This means that they took distributions in excess of basis of $19,000. So what happens from there? As we move to their 1040, we see line 8 from Schedule 1 is the $10,000 of net income from their K1. There's capital gain of $19,000, because remember, if you take distributions in excess of basis, you've distributed profit you didn't really have, right? You didn't earn that profit. So it's capital gains on your personal return. And then that gets factored into the rest of the tax calculations. So here's their $10,000 from their K1. Here's their Schedule E reporting the K1. Here's their 7203, their basis schedule showing that $1,000 starting basis, $10,000 of net income, total basis of 11,000, distributions of 30, right? That should match back to the basis schedule that came with their K1. Stock basis at the end of the corporation's tax year is 0. Then what you're going to have is a Schedule D reporting $19,000 of long-term capital gain. And here's how that reports on the 8949. Now, your software may do this automatically. And I'm going to make this a little bigger so you can see it. Your software may do this automatically if you've been filling out the basis schedules. Like I used Drake to prepare this. Once I filled in the basis schedules and entered the K1, it produced this form automatically. But you should be able to do this even if your software doesn't do it automatically. You should be able to know what it's supposed to look like. So generally, it'll report as excess distribution, and then the S-Corp that the excess distribution is related to. Proceeds are $19,000. There's no cost basis on excess distributions, so the full amount is subject to capital gains. Any questions on that? Is this something that you've had to deal with before? Is this something that maybe you've missed? And you don't necessarily have to admit that if you don't want to. I'll be honest, very early in my career, this was not a thing that I caught. Like, this was not a thing that I necessarily fully understood how to do. So I would imagine if I were to go back to look at some of my S-Corp returns from 11 years ago, this might not be what actually happened on those tax returns. Serena, you have a question? Oh, you're muted.
Oh, yes, I do. Are the extra contributions, are they always a long-term capital gain? And why would it be long-term versus short-term if it's only from like year to year?
So that's a good question. I would need to look up I will have to look up the citation on why it's always considered long-term. It is year to year. So I don't have the code section that I can cite to you for that, but I'll get it to Imelda so she can send it out. Let me make a note. If anyone happens to know it off their top of their heads, feel free to shout it out. 1 second. For LTCG treatment. Okay, of excess distribution. Okay, so I'll have to get back to you on that one. Trudy, you had a question?
Yes, and it's more, okay, so let's say you have somebody who's been just a sole provider LLC for 5 years. Then they decide they want to be taxed as an S-Corp. Do we start a checking account and everything, or how do you deal with that?
So if they were already an LLC, then when they elect S corporation status, it's not a new entity, it's not a new EIN, so they can continue to operate from the same bank account. If it was a sole proprietorship, they had to form an LLC first to make the S election, then it would be a new bank account, new EIN, new everything. So
Okay.
Back to your example, if it's a single member or multi-member, whatever, if it's an LLC that already exists and you elect S corporation status, what essentially happens, and whether if you're doing bookkeeping or whether the bookkeeper actually does this in the books, this is essentially what is going to happen on the balance sheet of the first S-Corp tax return. You're really going to zero out everything in the LLC's books. So all of the cash, all of the assets, all of the liabilities technically will get distributed to the LLC member, and then that member will contribute them on day one of the S corporation. So for example, if there was $10,000 sitting in the bank account and that's all that was on the balance sheet, right? Like they had no liabilities, no other assets, they would essentially distribute $10,000 to themselves. And then on 1/1 of, or whatever is the effective date of the S corporation, they would contribute $10,000. So their initial capital contribution to the S corporation is that $10,000 that was sitting in the checking account on the last day of the LLC's existence.
So would you do journal entries for those then to?
I usually do, and this is kind of a hotly contested topic. I was just having this conversation with my business partner last week, actually. I asked him if he actually makes the entries in the QuickBooks accounts, and he said he doesn't. He treats it correctly on the tax return, but he doesn't do all the stuff in the books. I tend to like to do a closing entry to close out the LLC and then an opening entry to open the S-Corp. I just like to have that clear line. I like to see that $10,000 as a capital contribution in the books, so I make sure it's picked up correctly on the tax return. Now, that can get a little messy if the liabilities exceed the assets, right? Then the entries get a little wonky, but generally speaking, I will do a closing entry to really distribute everything to the LLC member, which doesn't matter, right? Because on a Schedule C, you're not reporting a balance sheet, you're not tracking excess distributions. And then I make an entry, so say 12/31 of 22, I would have distributed everything to the LLC member, and then on 1/1 of 23, I would have recorded an opening entry to contribute them back to the business and then carry forward. Do you have to? No, I like to. For me, it just makes it easier to tie out that first year balance sheet and then every year after that. Otherwise, I'm going to have to keep work papers like the retained earnings in the books is $60,000, but really it started at 0. Like, to me, it's just easier to have put a period on the business before the election. But that was a great question.
I agree with you. I'll do that one.
So Robin asked in the chat to review distributions in more detail. What is considered distributions? Yeah, this is a fun one. Essentially, in really broad strokes, any money that's taken out of the company for the personal benefit of the S-Corp shareholder or the LLC member, whatever, of the business owner, that's not wages, is going to be a distribution. Now, this is one of those kind of gray areas of bookkeeping. You can handle things a bunch of different ways. My preference is to keep all personal expenses off the P&L and keep it all in a distributions account on the balance sheet. So for example, if you have an S corporation where the car is owned by the S Corp member, it's not a company asset, but they keep putting gas on the company card. Those are all distributions. And in the books that I keep, those get recorded as distributions because it's fuel to fuel a personal vehicle. Now, at the end of the year, we will reclassify some of those distributions to accountable plan reimbursements like mileage reimbursement based on their actual business mileage times whatever that year's IRS mileage rate is. So at the end of the year, some of those distributions are going to get reclassified and moved back to the P&L. But throughout the year, we're tracking those in a distributions account. I've also seen bookkeepers who will have maybe an other expense account just called, personal expenses, and they'll record all of them on the P&L. I don't like doing that though, because when your client runs a P&L throughout the year to get, the pulse of their business, it's going to look like their net income is lower than what's going to report on the tax return. Because remember, all of those personal expenses are not going to be reported in the expense section on the tax return. So their P&L might show profit, net income of $30,000, when in reality, they paid $30,000 of personal expenses in the business, so the net income is really $60,000. So for me, it kind of obscures the picture and can make it a little bit more difficult when we're doing our tax projections, because we have to make sure we know which categories on the P&L aren't really business expenses. And so it just increases the potential that we'll get the projections wrong. So Robin, really any personal expense that's paid for through the company is going to be a distribution. Now, what's considered personal expenses? that's where you can really start getting into the weeds. Like, if I go to dinner with my spouse, who is not an employee of my company, nor is he an owner, but all we do is talk about the company. Like, we did planning together, you know, he's my most trusted advisor. So even though he's not part of the company, he's who I bounce my ideas off of. He's who you know, I'm not very risk averse. And so he's kind of my pulse check. Like, is this too crazy? Am I just too off base here? Is that meal considered a business meal, even though he's not a client and he's not an employee? I don't know. See, there's a lot of gray area in deciding what's a distribution and what isn't. But again, in just broadest terms, any personal expense that's paid for through the company is going to be a distribution. Yeah, and you handle it on the balance sheet too. Yeah, you know, there's the one thing that I do like, and I'll, up until this year, in my own company's books, because I'm one of those bad accountants who has not yet outsourced my own bookkeeping. I have outsourced my own tax planning and my tax prep, but I still do my own books. To make it really easy for myself to keep track of my own basis, up until this year, because now I have a partner, you know, I admitted a partner into my business, and so distributions work a little differently now, but up until last year, I actually had an other expense account on my balance sheet called distributions moved to the balance sheet. And I recorded all of my distributions onto my P&L so that I could really quickly see that net income after distributions. And as long as that stayed a positive number, I knew I wasn't going to be taking distributions in excess of basis, right? As long as my distributions were less than the profit, I'm never going to run into a situation where I distributed too much. So for me, because I wanted to be lazy and just be able to very quickly at a glance know if I'm bumping up against basis issues, I tracked my own on my P&L. So, but for clients, they don't necessarily understand that it doesn't belong there and that that net income that they're looking at isn't their actual net income. So I generally won't do it for clients. Nishan pointed out medical expenses, home mortgage. I see all of those. Yes. I see so much crap run through people's books. Like, they're just steady swiping their business cards. And this is probably a good time to point out that it is possible for something to be a business expense, but not be tax deductible. Entertainment, for example, it perfectly and correctly belongs on the P&L if it's business related entertainment, but it's not going to be on the tax return. So in those cases, it's fine. And what I generally do in those books is I'll have an other expense called non-deductible expenses. And then I'll have a sub account for like entertainment, penalties and interest. And then I'll track it on the P&L where it does belong, but I'll clearly identify it as non-deductible expenses so that the tax professional, if it's not me, doesn't miss it. So it doesn't get, you know, lost in the sauce. So there's a bunch of different ways. And if you work with clients like I do, who are small businesses who are not required to follow US GAAP, US generally accepted accounting principles, you have a lot of flexibility in how you keep the books. I love that and I hate that. I love it because I can make sure that the financial reports are set up in a way that's very useful to the client, but I don't like it because it doesn't have as many rules to follow, and so it's kind of hard to teach sometimes. Because everything is like, well, you could do it one of 18 different ways, and that makes it very hard to teach bookkeeping or to make sure that books are done consistently across your client base. But I like it because the P&Ls that I prepare for my clients, as an example, service businesses do not have cost of goods sold. On the tax return, you should never see cost of goods sold if it's a service business because they're not selling goods. Cost of goods sold is literally the cost of selling goods. And so if they're a manufacturing company, if they're a retail company, they'll have cost of goods sold. But if you're an accountant or a plumber, you're not going to have cost of goods sold. However, on the P&L, on the book P&L, I love having a cost of goods sold section because I like teaching my clients the difference between direct expenses and overhead expenses, especially if you're a service-based business. And so because my clients aren't required to follow GAAP, I have some leeway in making the financial reports set up in a way that's actually really helpful to my clients in running their businesses. We kind of went off on a tangent there, but these are some great questions. Nishan also pointed out donations under other expense as well. That's a great point. So for S corporations and partnerships or pass-through entities, Charitable contributions are not deductible on the entity return. They get reported on the K-1, and then they're taken on the personal return if the K-1, if the person can itemize. So oftentimes, when I'm reviewing S-Corp returns from a previous, from another preparer, a new client to me, I have many times seen charitable contributions listed as an other expense on the 1120S, and that is incorrect. It's a separately stated item on the K-1, and it flows through to the shareholder's Schedule A. Now, on the book side, you could track it on the P&L if you want, as an other expense, or I've seen it often just as a regular expense. I tend to like having them on the balance sheet. I'll have a sub-account of distributions for estimated tax payments and for charitable contributions, so I make sure I don't miss those on the personal returns. But you will oftentimes see them on the book P&L. Just remember, just because you see something on the book P&L does not mean it belongs on the income or expense section of the 1120S. There's a lot of book to tax differences that you have to think about with pass-through entities. Tiffany pointed out, for some professions with licenses that belongs to an individual and not the firm, example, realtor and insurance agent, how do they assign their income in 1099 NEC to their S-Corp? You can't. Assignment of income is not allowed. So if, and this happens a lot with realtors, some states will allow the real estate agent to transfer their license to their LLC. Virginia is one of those, Florida is one of those. There are other states that don't allow it. So if the real estate agent is in a state that allows the license to be transferred to their entity and they actually transfer it, then their LLC can be paid. So commissions will get paid to the LLC and they can elect S corporation status. If they're in a state that does not allow their license to be transferred to their entity, they are not allowed to report as an S corporation. Assignment of income is not allowed. It's specifically disallowed. And if you want a court case to look up to back this up, look up the Fleischer case. Let me see real quick if I can find the site for that. This was a tax court case. I believe he was a financial advisor. Let me see. Fleischer v. Commissioner. So I'm going to link to a non-authoritative source, but then you can use that to go find the actual tax court case and the findings. So to recap that, if they're not in a state that allows the license to be transferred to their entity, they are not allowed to report their income on an S corporation. Now, does it happen? Sure. All the time I see a Schedule C that reports the 1099 NEC with an equivalent expense for the same amount, making the Schedule C net zero, and the other expense is reported on S-Corp return, blah, blah, blah. That's not allowed. That is specifically disallowed. So if you're doing that, you should definitely stop. It kind of sucks, right? Like, it removes a pretty big tax planning opportunity from clients who are in states where that's not allowed, but then they're going to have to take it up with their state representatives and try to get the law changed.
So, Andrea,
Yeah.
I just heard you said that you're not supposed to do the put the 1099 NEC in a Schedule C and then subtract the entire amount and
Correct.
say please see S-Corp. I've seen that happen, so I'm glad that you mentioned that is not allowed. Shouldn't be done.
I've seen it done, and I can neither confirm nor deny that I may have done that in the past before I knew it was not allowed, but I cannot confirm that,
Okay, thanks.
but I can confirm that. I mean, by now y'all probably know I'm not afraid to put my own self on blast. It happens. Yeah, so the link that I sent to Sean, again, that's not an authoritative source, but at least it'll give you the case information, so then you can go find the tax court case. And then, do I know off the top of my head if California is one of those states that allows this? I don't think that it is. Does anyone on here know for sure? I feel like it's not. But I would have to get back to you on that.
I have a question that, okay, so I have quite a few real estate, but most of them aren't taxed as an S. So then if they have a 1099 NEC that their business, it came in their name instead for the license. Does that mean we have to do a Schedule C on that you're saying we can't put that? Oh, God.
Yep,
I did not know any of this. Okay, so that makes,
yeah. Yep, they're not allowed to assign the income. If the 1099 was issued to the individual or to their, well, you shouldn't have any 1099s issued to their LLC if their state doesn't allow it. Their brokerage should be making sure that their license was transferred to the LLC before they'll issue payments to the LLC. So if you find you're in a state that doesn't allow it, but there's a brokerage that's doing it, that might be a problem. And brokerages generally know the rules and they're generally going to follow them correctly because they go through all kinds of testing and licensing and they don't want to run afoul of rules like that. But so you shouldn't see it. But yeah, if the 1099 is issued to an individual, you cannot report it on the S-Corp. Even if they deposited the money to the S-Corp bank account, they should not have, and it doesn't get reported on the S-Corp return.
so they're gonna need to do two things then.
Yep, they're gonna have a Schedule C to report the income, and at that point, I would recommend that they report the expenses on the Schedule C because they're gonna be subject to self-employment tax.
Right.
So
So probably an S-Corp just doesn't work for them then.
doesn't work for them. Yeah.
Okay, perfect. Thank you.
How can we
Because I
find
do have
info with
life
each
insurance.
state? You might, you would probably have to do, so the question is, how can we find that info with each state? I don't know of any one resource that lays that out because each type of license could be like a different licensing board within each state. So you probably have to go to whatever that state's licensing board is. And you may even have to pick up the phone and call them because sometimes it's not clear on their websites. So you may end up having to pick up the phone to call the licensing board for whatever state your client is licensed in. Tammy asked, where do you put the interest paid to a shareholder for a loan to the S-Corp? Is it put on interest and a 1099 interest given to the shareholder? What about the opposite, a loan to shareholders? So interest income for the S corporation, whether it's from a bank. So I'm going to start by talking about interest that's paid like from bank accounts and investment accounts. Interest received by the S-Corp for interest on like bank accounts does not get reported as other income on the 1120S. I see that all the time, and that's not the correct reporting. So for example, my S-Corp return had, $50K sitting in a savings account, and I earned $1,000 of interest in 2023. I got a 1099 INT issued to the S-Corp. It's in my books as interest income. On the tax return, it gets reported on the K1. So it's a separately stated item on the K1, and it reports on the individual's tax return. So it is not other income on the S-Corp return. Now, interest on a loan to the shareholders, I would have to research it because if they're not in the business of loaning money, if that's not their normal business, then that's not interest income earned in the normal operation of the business. So talking it through, it seems to me that interest on a loan to a shareholder or to somebody else would be treated the same way as interest from a bank. It's basically investment income, which gets reported on the K1. Now, if the S-Corp is in the business of loaning money, for example, they're hard money lenders, right? They loan money to real estate investors, and that's what they do. That's what they were formed to do. Then it would probably be treated as just regular operating income because they're in the business of loaning money. How about if a 1099K is issued to the S-Corp owner's social security number? Is there a way to assign that to the S-Corp? The funds went into the S-Corp bank account. So that's a great question. The tax form does not dictate the tax treatment. I'm going to say that again. The tax form does not dictate the tax treatment. So just because somebody gets a 1099K doesn't mean they have reportable income on their tax return. Think about all these people who are in an uproar if the 1099K threshold drops down to the $600 and they've been, sending money to their family through PayPal or, selling stuff at a yard sale. They're going to get a K1 for that income. That doesn't mean that income is income that is taxable or that has to be reported on their tax return. So in this example, if the 1099-K was issued to the S-Corp owner's social security number, that doesn't necessarily mean they have income that's reportable on their personal return. Now, I would encourage them to get an account set up in their business name and EIN as soon as possible to avoid this in the future, because you could end up with a matching issue and get a notice. But in that case, if it was for income that was, services delivered properly by the S-Corp, not restricted, like not someone selling something they're not allowed to sell, not a real estate agent collecting commission through PayPal, and they're not allowed to be an S-Corp. As long as it's in the normal due course of business and business that's allowed, the money is paid to the S-Corp and it's deposited to the S-Corp bank account and it's reported, then that's fine. So as long as it's not prohibited activities, then it can be reported on the S-Corp, because that's not really assignment of income. That is money that was paid to the S-Corp correctly for services or goods sold by the S-Corp. That would be an accurate reporting.